Imagine if every company reported profits however they wanted. One business could count future sales as income today. Another could hide expenses completely. Investors, banks, and governments would have no idea what's real. That's why accounting principles exist. They create a common language so financial statements are fair, consistent, and trustworthy. Today, I'll explain the main accounting principles in the simplest way possible. Before we go through each of this, it's important to know that there's no single official number of accounting principles. Some textbooks list around 7 principles, others list 10, and some include even more depending on how they classify assumptions and concepts. That's why students sometimes get confused when comparing different sources. So instead of focusing on the exact number, it's more important to understand the core ideas behind them. To keep things simple, as seen on the screen, we'll group them into 3 sections: core principles, accounting assumptions, and accounting concepts. Let's start with core accounting principles. Revenue recognition decides when revenue should officially be recorded. In accounting, businesses don't simply record revenue when cash arrives. They record it when the work is completed or the product is delivered. In other words, record revenue when it's earned. The matching principle works closely with revenue recognition. It ensures that expenses are recorded in the same period as the revenue they help generate. This helps businesses calculate profit more accurately instead of making one month look artificially high or low. The accrual principle focuses on timing. Transactions are recorded when they happen, not when the money is exchanged. This gives a more realistic view of business performance. Finally, the cost principle says that assets are usually recorded using their original purchase cost. Even if market values change later, accounting records often continue using the original cost because it is objective and verifiable. Together, these principles create the foundation for how accounting measures business performance. Now that we've covered how accounting records transactions, let's look at the assumptions accounting systems are built on. These assumptions create the basic environment accounting operates within. The going concern assumption means accountants assume a business will continue operating into the foreseeable future rather than shutting down tomorrow. Because of this assumption, businesses can spread costs across multiple years and plan long-term operations. The economic entity assumption separates the business from the owner personally. Even if someone owns the business, personal transactions should not be mixed with business records. The monetary unit assumption means accounting records are measured using one consistent currency. This allows financial information to stay organized and comparable. The time period assumption divides business activity into reporting periods like months, quarters, or years. This makes it possible to regularly measure business performance and prepare financial statements. Now, let's move into the accounting concepts that help guide financial reporting quality. These accounting concepts help guide how financial information should be presented and interpreted. The full disclosure concept means businesses should include all important financial information, which could affect decisions made by investors, lenders, or other users of financial statements. Materiality focuses on importance. Not every tiny detail needs the same level of attention in accounting. Businesses focus more heavily on information that could actually influence decisions. Consistency means businesses should continue using the same accounting methods over time whenever possible. This makes financial statements easier to compare from one period to another. Conservatism encourages caution in accounting. When uncertainty exists, accountants generally avoid overstating profits or assets. Finally, objectivity means accounting information should be based on reliable evidence rather than personal opinions or guesses. Together, these concepts help make financial statements more reliable, comparable, and trustworthy. So why do accounting principles matter? All three sections work together to create a complete accounting system. Core principles control how transactions and profits are recorded. Accounting assumptions create the foundation the system operates on. And accounting concepts guide the quality, consistency, and reliability of financial reporting. These three combined help create reliable financial statements. Without these principles and concepts, financial statements could easily become misleading or impossible to compare. Together, they help businesses produce financial information that investors, banks, governments, and managers can trust. Without these rules, businesses could manipulate profits, hide expenses, or make their financial performance appear stronger than it actually is. These principles also improve consistency. When companies follow similar accounting rules, investors and other users can compare businesses more easily. This becomes especially important when banks decide whether to lend money, investors decide whether to buy shares, or governments calculate taxes. Accounting principles help ensure financial information is more reliable and useful for decision making. Now, let's quickly see how well you understood this with a real-life example. Let's say you receive an electricity bill for this month's usage, but you pay it next month. Which principle applies? Revenue recognition, accrual principle, or cost principle? The correct answer is the accrual principle. Even though you pay the bill later, the expense is recorded in the period when the electricity was actually used. This is exactly what accrual accounting focuses on, recording transactions when they happen, not when cash is paid. That's everything about accounting principles. If this video helped make this topic easier to understand, make sure to like and subscribe, and comment below if you want more examples like this or if anything is still unclear.